Hey everybody, my name is Brendan from thestockstreams.com, and today I want to talk about the three stocks that I'm watching this week. Those three stocks are Lucid Motors stock, ticker symbol CCIV, AT&T stock, ticker symbol T, and lastly Palo Alto Networks stock, ticker symbol PANW. So now let's get started. So here we are in CCIV stock, also known as Lucid Motors, and we can see here that we've had a pretty nice week, up about 20%. Now, I think a lot of this has to do with the surge in retail interest as shown in stocks like AMC and BlackBerry. So the red crowd has been looking for stocks which are pretty speculative, which Lucid is, and also stocks that have high short interest, which Lucid has. So the reason why I'm watching Lucid this week is because if we look at the price action on Friday, we can see that we are up over 4%. That's interesting to me because if we pull up a chart of AMC here, we see that the speculative names that the Wall Street Bets crowds were pushing last week were actually down big on Friday. So if we look down at the news here to try and understand why we are seeing that disconnect between Lucid and other stocks like AMC, we can see this story about the Rivian IPO valuation. Because Rivian is also an EV maker that makes something similar to what Lucid is making, and because Rivian's IPO valuation was quite high at $50 billion, people are thinking that this nice valuation could carry over to Lucid here. And right now, Lucid's valuation, if we look at the market cap, is only around $6 billion. This is an extreme discount to Rivian. So to me, this is an interesting situation, and I think this actually plays into more market psychology than true fundamentals of Lucid. This to me sounds like the concept of anchoring, meaning that we quote-unquote anchor our perception of what this thing is worth in relation to a similar object. For instance, let's say we have this BlueBerry phone here. Definitely not a BlackBerry phone because no one ever uses those. Let's say I tell you that this BlueBerry phone is worth $1,000, and I show you this phone here, a similar BlueBerry phone, and I ask you, how much do you think this is worth? Well, using your pretty smart brain, you might say it's worth a similar amount to this BlueBerry phone which I showed you, which I told you is worth around $1,000, because that's the only thing you have to anchor your perception on how much BlueBerry phones are worth. Again, not BlackBerry phones, because the last time someone used those was when the dinosaurs were roaming the earth. So without any idea on the technical specs of the phone, or even if it works, I've anchored your price perception of this phone to $1,000. To me, this is kind of what's going on with Lucid and Rivian here. Rivian looks to be anchoring the valuation of Lucid Motors. Anchoring is a very interesting concept, and the theory goes much deeper than this BlueBerry example, so I encourage you all to read up on it, but because time is short around here, let's move on over to Lucid Motors trading charts. And we can see here the technical indicators of Lucid look a little soft here. We seem to be at a resistance level right now around the $24 level, made from the tops of these candles, and the tops and bottoms of these candles over here. Because we've hit this level so many times, it looks to be pretty strong resistance to me. Because of that, we might not be able to break through the $24 resistance level this time. However, if we do that, because of the push from the retail investor crowd, and we are able to close above this resistance level, then that is a bullish sign. So that is another thing that I'm watching this week. Looking at the MACD chart here, which is a measure of momentum, it looks to have flattened out dramatically. And that's telling me that the momentum in the name is definitely not as much as we are seeing back in early February. Also looking at the RSI here, we are coming precariously close to the overbought territory above 70 here. Because of this, for me, I want to see how the stock reacts with the retail investor crowd. So if we are able to push above the $24 level, then Lucid looks more interesting to me. However, if we are unable to pass this resistance level, then we could fall back down to the $18 to $20 level, which has been a nice support. And it's the first place where I would be looking to pick up shares if I wanted to pick up some CCIV. So after talking about Lucid, now let's talk about AT&T stock. So here we are in AT&T stock charts here, and we are actually at a pretty interesting spot. We seem to be at a very long-term support level around the $29 level, made from the tops of these candles over here and the bottoms of these candles over here. We can see that ever since our health crisis fall here back in March of 2020, we have been really waving out between this $28 level and let's say $30 level with some spikes above and below. So because of that, if the stock falls back down to the mid to low 28s, then that would be the place where I would be looking to add more shares to my position. and that is why I'm watching the stock this week. Now, we actually seem to be trending upwards out of this range here, but then we announced a deal with Discovery, if I zoom in here, which crushed the stock back down into this range between $29 and $30, and we've been consolidating here ever since as investors figure out what to do with the shares, because there are fears that the dividend would get caught. And if we look at Google here, the dividend on AT&T right now is around 7%. However, if we take a look at this article here, honestly, the dividend will likely be cut if this deal goes through, because by spinning off a part of AT&T's business, well, obviously there are now less things that are yielding revenues for AT&T. So because we'll gain less revenues, we'll gain less dividends as shareholders. Now, firstly, simple math here, the expected dividend cut is around 50% from where we are right now. And if we look at this Google machine here, we can see that our current dividend is 7%, so 50% of 7 is 3.5. Now, honestly, that is still a pretty good dividend. The average dividend yield for the S&P 500 is around 2%, but I understand that it is still a far cry from the 7% where we are currently sitting, so I understand why people are not too happy. Shareholders do get a large majority of the new business, but they have to weigh out the growth potential against the loss of the dividend. Again, because time is short, I encourage you all to read more about this deal. This deal merges two streaming companies in an attempt to take market share in the streaming wars. Now, I've talked a little about a business and economic theory in the past called the rules of three. Basically, what it's saying is that in any mature market, there really emerges only three main competitors. And this is a screenshot from what I believe is the actual original paper that explained this theory put out by some guy named Bruce Henderson. Basically, right now, think of the top three competitors in the streaming space. There's Netflix, Disney Plus, and the third seat of the streaming wars is unclear right now, and that's why this is a race. You could say Amazon Prime streaming is in third place, but that number is kind of funny because I'm not sure how many people bought Prime just for the streaming or use streaming, and I believe that streaming is looped in to the whole Prime subscription thing. So really the race is on right now to identify who's going to get the third seat, and by merging HBO, Warner Brothers, CNN, and into Discovery, then that makes a pretty good competitor. However, Amazon looks to be buying MGM, so there is incredible competition for that third seat. For me, even though I don't really believe in the rule of three, I think that's more of a psychological trap than what actually plays out in reality. I believe that this merger is a good but risky opportunity for growth. Again, while it's good that merging HBO, Warner Brothers, and Discovery into a mega business gives it a chance to compete for that third seat, you are competing against Amazon here, which is a company that I would never want to compete against. So anyways, for me, long story short, I'm still in AT&T because there's a 7% dividend until that, and even after that deal goes through, it would be 3.5, which is better than what I would normally be getting in the S&P. I also have AT&T as a 5G play, and the stake in the new company is just an additional call option that I'm not really caring too much about. I would like to talk a little bit more about the deal of what's going on here and how that affects shareholders in general, and maybe I'll do a whole video on AT&T, but for now, because time is running out here, I now want to talk about Palo Alto Networks, the cybersecurity company. The last company I want to talk about today is Palo Alto Networks, the cybersecurity company. This is actually a company that I really like because it is in the cybersecurity space. As I mentioned before in the BlackBerry video, there have been a ton of attacks in the past few weeks. From the Colonial Pipeline to the JBS Meatpacking to even the Steamship Authority in Massachusetts, which is in charge of ferry boats going to and from Martha's Vineyard and Nantucket. Businesses are getting hacked, and in order to defend themselves, they need to hire cybersecurity companies like Palo Alto or Zscaler or FireEye or even BlackBerry. Right now, to me, this is one of the most pressing issues of today and needs to be talked about. We will not talk about the political implications of these hack attacks here, again, because this is not a political show, but the United States government looks to be finally wanting to firm up our cybersecurity defenses. And if you ask me, this is years late, but better late than never, I guess. And the government will likely be turning to private cybersecurity companies to help with these threats.
This is why I think cybersecurity companies will have large macro tailwinds for the future, as a lot of private companies and the government will likely be investing heavily into this space for the next few years. Now, I want to transition over to Palo Alto's most recent earnings report here, and we'll see that Palo Alto is growing total revenues nicely here year over year. However, if we look down here at the net loss, we actually see that we are still losing money and the loss looks like it's accelerating. And that's not normally what I like to see at all. But if we look at Google here, we can see that Palo Alto is valued at around $34 billion by the market cap here. And if we look back at the revenues, we see that we are actually only making about $1 billion in revenues. So because of that, we are trading at a 34 price to sales ratio, and that is definitely expensive by any means. That means that this stock is a high flyer, meaning that this is a high growth story, meaning that it is vulnerable to getting hit by higher interest rates, which will likely come. However, as I said in the previous part of Palo Alto, I think the macro story outweighs this fundamental weakness, in my opinion. Again, as always, you have to decide for yourself if you think the macro outweighs the fundamentals or if it does not. You are a smart cookie and you can make your decision yourself. Looking at the trading charts here, we can see that Palo Alto is trading in a pretty large range ever since December of last year, from the low 300s down here to the upper 300s up here. And really, this is like a 20% trading range. So for me, I'm watching the stock this week to see if we can get down back to the 330s or even lower so that I can add more shares to my position if I wanted to add more shares to Palo Alto.